significant discount. That discount is one of the factors which provide you the margin of safety. The other factors which provide you this margin of safety are that you do a conservative projection of your expected cash flows. The timing is also conservative, which means the cash flows are assumed lower, the timing is assumed later, and the of the cash inflows is assumed later, and the discount rates are assumed higher. If you take all of these things, you have now 3 levels of margin of safety, and that's how you do a valuation. And if you can find a security cheaper than even that, then that's when you make a buy. Now, Graham has been talking about this from 1934. He's in his book Security Analysis, and he's considered as the dean of value investing, or the dean of investing itself. However, this is a very basic concept which all prudent businessmen know, or all prudent investors know, and intuitively carry it out, that you should pay less than the value of an asset to buy it, and you should sell it at when there is a buyer available for higher than the. That's what a rational investor is. Okay. So to summarize, the difference between the efficient market hypothesis and value investing is that the efficient market hypothesis believes in high returns being a result of high risk, while value investing believes in high returns being coming out of low risk. When you take low risk, when you pay less amount, when you're buying significantly below the intrinsic value, is when you get high returns. Efficient market hypothesis suggests that no amount of research or data gathering will yield risk-adjusted returns, high risk-adjusted returns, because all analysts, all researchers, all investors have that same information available, and hence can get those returns. So you can't really outperform anyone else. On the other hand, value investing looks at situations and analyzes that there are instances where there is a high perceived risk, which is why high returns are available. However, the actual risks might be lower. These are rare instances, but they are possible. This is what is the belief of value investing, and the job of a rational value investor is to sift through a lot of those high perceived risk opportunities and find those rare cases when the actual risk is much lower. So value investors do believe that market is populated by rational investors, and most of the time the valuations should be appropriate. In the rare case when they are not, they pounce and they invest heavily and get their high returns. The third leg of efficient market hypothesis is that the market is in equilibrium and all investors are rational investors. Our value investors believe that many times in most markets, some securities are always available which are mispriced, and sometimes most markets at some point of time will be mispriced. So, and this we have just gone through various empirical studies over decades across the international markets which prove this. So how do we apply in practice? This is all good to hear, and you say fine, I mean value investing works and maybe there is a case. But how do you apply this to alternative investment markets? How do you look for low price to book and low price to equity, low price to earnings? And so it's not just that, there's much more to it. However, the principle was that it is possible to have high returns while maintaining low risk. And the job of a investor in the alternate investment markets is to look for pockets of inefficiencies in these alternate asset classes. And how do you find that? You look for things. What are the strategies to search for this? You look for assets which are not on the radar of most investors. There are fads, or there are asset classes which become very popular. The value investor normally looks for things which are not on the radar. Second is, which assets do not have adequate public information available. There are securities or asset classes or markets where information is less known. For example, when in 60s, most American investors would not have ventured out of either the English-speaking countries. But John Templeton looked at the Japanese markets. And of course, a lot of information was not available. First of all, was not disclosed even in Japanese. And definitely very few companies published their results in English. So the information availability itself was an issue. So when you work hard on that angle, and he would go and get a lot of documents translated from Japanese to English and go through it, and he could get exceptional returns. It's legendary, the global investing of Templeton. Okay, which assets are difficult to analyze? So another way, a place where you can look at. There are a lot of assets which are difficult to analyze. It's complex structures, multi-level holding structures, etc. And it's difficult to see. There are assets which are hidden from the public eye. And if you dig deep enough, if you analyze the tough thing, you will be able to find once in a while those assets. There are assets which suffer from a negative bias. If you think about it, in the late 90s, the US markets, the listed markets, were completely binary. There were these technology stocks which were extremely hot, and the brick and mortars which were suffering a negative bias. So you could clearly go into the US markets in late 90s and buy a Procter and Gamble, Coca-Cola, and American Express and stocks like that, which were suffering a negative bias at that time. The investors. Most investors have liquidity horizon within few months or within about a year, a 12-month horizon. So if someone looks at a liquidity horizon or a holding period of about 3 years to 5 years, chances are high that you will be able to find gems which will unlock value over that time period, that holding period, and hence be able to beat the market. Which assets are being transacted? They are holding a security, and the company has done a stock split, and they have demerged a small spin-off. Now that is below the holding market cap defined for those investors. So they're not allowed to hold stocks below a certain market cap, and as soon as they get that demerged entity shares, this is an example of what kind of constraint. When people want to make their mutual funds look all the losers in the market, and some of them will go below their intrinsic value. Which assets are being transacted by investors with higher low discount rates? So if you look at the Indian markets, there are at least two different kind of investors, the domestic investors and the foreign investors. Now the foreign investors are borrowing money in their own currencies or from other international sources, where the discount rates could be very low, even adjusted for the risk of country risk and currency risk. So if, and the Indian investors, the discount rate is dictated by the local government treasury. Okay, so if there is that kind of a difference, then you can arbitrage on that and make money safely. So the idea is to understand those perceived risks. Okay, so market perceived high risk is what results in the high returns. A deep study of the risk factors will give you an insight into why those, what are those specific risks, and then you apply your mind to whether your team and yourself can manage those risks, whether you can eliminate, if not mitigate, if not manage those risks or isolate those risks. If that is possible in some instances, that is when you have got your alpha opportunity. Okay. That's about it. These are some of the references which we have used, which these studies are we are citing. Now we would like to listen from you and have your feedback or questions. Thank you.
Thank you, Dr. Gupta, for that excellent presentation. Thank you for taking us through the alpha, the value investing, and the alternate asset class systematically, thereby merging the three with proven data and various examples. Ladies and gentlemen, we can take our question and answer right now. Please mention your name and the organization you represent before asking your question.
There is a question which says which class of assets are easy to analyze. Normally the listed equities and a portion of the listed equities where the large caps, where there is a lot of information available